Are we really going to make a video about what is value investing? Did I run out of video ideas? Actually, I wrote a blog post for eToro the other day. It is supposed to be only 700 words about value investing. But I had much more things to say. So that's why today I wanted to make this video to talk more about value investing. By the way, now I'm an approved value investor on eToro. So maybe that gives me some authority to talk about value investing. There was also a tweet which I saw the other day. Someone said that they invested in Home Depot and it is part of value investing. I don't really agree with this. That person doesn't identify themselves as a value investor. They cannot just say that this one investment in Home Depot is a value investment. It's because some people will say that Home Depot is a value stock. I don't really agree to this description that there are some value stocks, growth stocks, etc. You are either a value investor or you are not. That's it. You can be a value investor. Maybe you see value in a stock such as Amazon. It is possible to do that. So that's why today I want to talk more about what really is value investing. The first thing that value investors do, of course, is smash the like button for the YouTube algorithm. If you're new to our channel, my name is Ishfaaq. I am a popular investor on eToro, now an approved value popular investor on eToro, where I manage assets for over 140 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. Value investing is buying stocks when they are cheap, when they are being undervalued by the market. This theory, this investment philosophy, strategy, whatever you want to call it, of value investing was first developed in the 1930s by Dodd and Benjamin Graham. So we have that book, Security Analysis by Benjamin Graham, which is considered the Bible of value investing. It is by both Dodd and Benjamin Graham. And then there is one more book, it's called The Intelligent Investor by Benjamin Graham. This one is more for beginner value investors. So if you are a beginner as a value investor, you want to learn more about value investing, I would suggest you read The Intelligent Investor. But now if you're more advanced, then Security Analysis is the best option for you. The most famous value investor, of course, is Warren Buffett, who was at some point even the richest man in the world. If he had not donated all that money, he would still be the richest man in the world. So he donated over 30 billion US dollars. Warren Buffett is a value investor. And his return, since he has been CEO of Berkshire Hathaway in 1965, is 20.3%, compared to the S&P 500, which returned 10.0%. So you will see that he beat the market on average by 10% per year. It may not look like a lot, but over the long term, because of compound interest, it makes a big difference. For example, if you invest $1,000 today, over 50 years, at 10% returns per year, you will have $170,000. But if you invest the same $1,000 over the same 50 years, but at a 20% return per year, you will have over 9 million US dollars after 50 years. So you see the big difference. So as a value investor, you need to take that into consideration. Compound interest is very important for you. So you're investing not just for next year or not for the next decade, but for the long term. But of course, there are different types of value investors. We'll talk about that in a few minutes. There are some value investors who will buy stocks and hold them for a very long period of time, 20, 30 years. Other value investors will hold stocks for only 1 year or 2 years. But nevertheless, when they make a profit, they are going to take that profit and reinvest it to take advantage of compounding. But there is one thing that all value investors have in common. They know the difference between value and price. Investing is more than just looking at a number on a computer screen and then clicking on that number. After a few seconds, a few weeks, or a few months, you're going to make a profit. This is not value investing. Value investing is knowing the difference. What you see on the computer screen, this is price, but this is not the value of a company, of a stock, of a business. A business, it has an intrinsic value. It's like if you buy a farm or a house. Let's say there is a house which you bought, and you buy that house from someone called Mr. Market. You bought that house for $100,000. Now you own the house. If tomorrow someone comes, that same Mr. Market comes to you and tell you that now this house is worth $120,000. Are you going to sell the house to Mr. Market? I don't think so, because you bought the house, you want to live in it. It is an asset that you own now. And if after a few days Mr. Market comes again and tell you that now the house is worth only $80,000, are you going to sell because on paper you're losing money? Of course not. This is a house that you own. Now maybe you bought the house as an investment. It is possible that you did that. But you are not going to sell immediately. You are going to sell maybe at some point later, 10 years from now in the future, when the house is $200,000. Then you make a good substantial profit. This is what value investing is about. Because this house, it has an intrinsic value. A farm, when you buy it, it has an intrinsic value. When you buy a business, it has an intrinsic value. A value investor knows the difference between price and value. Like you said, the price is something that you will see on a computer screen. But the value of the business, you have to calculate it. How do you do that? There is no exact formula for that. There are people who have worked about formulas, about CAPM, about all these things. There are things like this. You can use them. I'm not telling you not to. But they are not 100% accurate. You need to think like a business owner. You own that business now. You need to think how much cash flow that business can bring to you. You need to analyze the balance sheet of the business, the income statement of the business, the cash flow statement, all those numbers. By the way, you can have a look on my research partnership where I talk about all these things. I have a course about investing for beginners. I talk about all this, and also I talk about how to find the intrinsic value of some companies. I've given some examples. For example, let's talk about the bank. When you're investing in a bank, you need to take into consideration the book value of that bank. Book value has a very important role to play. But when you're investing in a company such as Apple, book value doesn't have much importance. What's important about Apple is the brand name, the brand value, and you cannot put the brand value on the balance sheet. But when you value Apple, you need to take that into consideration. For some companies, cash flow is more important. For other companies, maybe operating income is more important. For example, when I analyze Sony, I look at the operating income of Sony as an important metric to consider. But when I analyze GameStop, I look at free cash flow. So it really depends on the company. Each company is different. Each industry is different. Each sector is different. And as a value investor, you will need to know that. And how do you know that? Is by doing your homework. You have to read. You have to read all these 10K, 10Q forms. You have to listen to those conference calls, or maybe read the transcript. I don't listen to conference call. I just read the transcript. But you need to do that to understand how businesses work. But the truth is that it doesn't matter how much research you do, how much analysis you do, how good you are as an investor, you're going to make mistakes. Because it is impossible to predict the future with 100% accuracy. So that's why you need to take a margin of safety. Let's say after all your calculation, you find out that the intrinsic value of a company is $100 a share. But now you see that the company is being traded at $95 a share. That doesn't mean that you have to buy the company, because it's only a 5% difference. Maybe you have made a mistake. If the stock price keeps crashing, then this is bad for you. So you need to take a large enough margin of safety, let's say 25%. Only when the stock price reaches $75 a share, then you're going to buy that stock. The next task of a value investor is to construct a portfolio. And this is where there is divergence between different value investors. In 1984, Warren Buffett wrote an article for the Columbia Business School. It's called The Super Investors of Graham and Doddsville. You can read that article. It's available for free online. And I also wrote about it, made a video about it last year. And for some reason, if you Google The Super Investors of Graham and Doddsville, my analysis of that is on the first page of Google. In that article, Warren Buffett talks about his friends, the students of Benjamin Graham and David Dodd, how each of them had different portfolios, different strategies, but all based on the same principles of value investing. For example, Charlie Munger. Charlie Munger had a very concentrated portfolio. He only had about 7 to 10 portfolio stocks at a time in his portfolio. But Walter Schloss had over 100 stocks in his portfolio at a time. But both of them were value investors, and both of them were able to beat the market. There were some investors who only had bonds in their portfolio, because this is what they were managing, some pension funds or something like this, and they were required to have only bonds in their portfolio. But they were value investors, and they were also able to beat the market. Warren Buffett also talks about Dodd. He was a chemistry major and then he became a student of Benjamin Graham and David Dodd. He became a value investor, started investing. His career was not that good in the beginning. He was homeless at the time, living on the beach. And then eventually, the next time that Warren Buffett called him, he owned the beach. So you see, it doesn't matter whether you're a chemistry major, physics major like me, or whatever major, agriculture, or I don't know, gender studies or whatever you do. If you want to be a value investor, it is not that hard. It is not that easy either. You need to put in the work. There's a lot of work for you to be a value investor. And whatever strategy you use, you have to stick to that strategy. It's not because today you're investing in 100 companies as a value investor that tomorrow you want to now be concentrated. Maybe you can change strategy, but it takes time. I suggest that you read that article. You will know more about the different types of value investors. So that's why I tell you, if someone, a value investor, invests in Home Depot or in Amazon, it doesn't matter. You can be a value investor investing in both. I don't really think that Home Depot is a good investment today. I see that the stock is expensive, so I don't really understand why someone would call that a value stock. Because for me, it's not. But it depends on your strategy. What you need to understand is the difference between price and value. If you see that the intrinsic value of Amazon is higher than its price, then maybe it is a good investment for a value investor. I don't see it like this, but maybe you know something about Amazon that I do not know. You have made better research than me on Amazon and you see that. So you can be a value investor owning Amazon. There is nothing wrong with that. So it depends on you as a value investor, your strategy that you're using. But the main thing, the main principle of value investing is knowing the difference between price and value. Many people will say that value investing is boring, but actually it's not. For me, day trading is boring because every day you have to stay in front of a computer. You have to look at moving charts. I look at charts, but they're not moving, they're static. I see day trading as boring. For example, at 5:30 p.m. here in Mauritius, it's 9:30 in New York. At 9:30, the New York Stock Exchange and Nasdaq are open. For a day trader at the time, they need to be in front of their computer screen and looking at those charts, moving charts. But for me, it's not like this. Because at that time, I'm watching the sunset on the beach. I live 50 meters from the beach. I can do that. So I'm a value investor. I can do that. I don't see that as boring. I would rather be on the beach at 5:30 looking at the sunset rather than looking at a chart on a computer. So for me, day trading is boring. And when we see the results, value investors have been making much more money over the long term compared to day traders. Value investors have been beating the market over the long term. Beating the market is not that easy actually. The stock market is a winning game, but most investors lose money in the stock market. So don't think that it is easy. There is a lot of work to do. As a value investor, you're a business owner, and that too, I see it as something very interesting because that's why I first started to think about investing. I was still a kid at school, and this was the first time I heard about investing in stocks in economics class. When I heard about it, it was not really about money. It was the idea that you could own part of a business. This is what made me interested in that. So today I am investing because I'm interested in owning businesses. Of course it is about making money. Of course it is about returns. But it is also about being a business owner. This is what really makes me happy to know that Apple is a $2 trillion company today. I felt proud to see that a company that I own is now a $2 trillion company. For example, Alaska Airlines. I own this business. I'm happy that when I'm reading the comments on Instagram, when the customers are happy about the services of that company, of course it makes me proud and happy. To conclude, what's more important for a value investor is understanding the difference between price and value, and then invest in companies when these companies are trading under their intrinsic value. To calculate that intrinsic value, there are multiple ways, and that's why value investing is not easy. Otherwise, everybody would have been billionaires. You need to make a lot of homework, a lot of research, but it is much more interesting than looking at charts, in my opinion. So let me know in the comments whether you are a value investor. What do you think about value investing? Thank you for watching this video. Please like, subscribe, and share. Please watch these two videos if you have missed them. Have a nice day and goodbye.